All right, let's jump straight into this explainer. Today, we're tearing into Starbucks' May 2026 financial data. And look, we really need to talk about a major reality check. Because for years, the narrative on Wall Street was simple, right? Starbucks is just this unstoppable global growth engine. Well, that narrative is completely dead. Today, it's really a contradictory tale of two entirely distinct markets. So to actually understand where this company is headed, we've got to take a fresh, hard look at its two biggest profit centers. So here's our roadmap for today's analysis. We're going to hit 5 key areas. First, the global divergence thesis. Second, China's structural market shift. Third, we'll crunch the traffic versus ticket math. Fourth, we'll look at the Boyu Capital joint venture. And finally, we'll reframe the entire valuation model. Let's dive in.
Section 1, the global divergence thesis. We are looking at a truly bifurcated reality here.
Notice the absolute stark contrast going on here. On one side, you have the U.S. turnaround. Management is over there actively fixing operational issues, stuff like drive-through speed, staffing allocations, and finally bringing some clarity back to the menu. And the thing is, those are fundamentally fixable, operational problems. But then, you look at the other side, the China market. What's happening over there is absolutely not just a simple operational hiccup. It's a structural repricing of the brand and a really persistent same-store sales drag. I mean, we're talking about a complete paradigm shift. Just let that global divergence sink in for a second, because it really sets the stage for everything else. Now, to understand exactly why this divergence in China is so incredibly dangerous, you have to look at the very foundation of the company. Starbucks' core business logic is literally to monetize habit. A strong brand makes consumers comfortable paying a premium. Sure, the coffee is the product, but the actual business, that's built entirely around a premium daily ritual. Their whole flywheel depends on that premium positioning. And China is actively threatening that flywheel, because if premium pricing suddenly fails to convert into actual foot traffic, the underlying economic logic of the entire brand starts to unravel.
Which brings us to Section 2, China's structural market shift. This is where the structural change is happening.
Just look at this massive number, 31,000 plus. That is the staggering store count that local competitor Luckin Coffee reached by the end of 2025. It's wild, right? For years, Starbucks thrived in China because its brand represented this aspirational, premium cafe experience. But seeing this astronomical scale from local rivals, that signals a violent, massive shift in the market. The whole category has basically morphed overnight from premium aspiration to high-frequency value.
And these local players, guys like Luckin and Cotti, they're aggressively attacking Starbucks across 4 very distinct operational vectors. First up is price. They're pumping out lower-priced drinks and completely resetting the consumer's reference point for what a cup of coffee should actually cost. Second is convenience. With app-native ordering and delivery, the need to go sit in a beautiful, big cafe is drastically reduced. Third, you've got product velocity. They're dropping rapid, highly localized flavor launches that create this constant sense of novelty. And fourth, density. We're talking tens of thousands of small format stores making value coffee incredibly accessible. The consumer's whole price-quality map has fundamentally changed.
Okay, moving to Section 3, the traffic versus ticket math. Let's get into the comp math. So take a look at the fiscal Q2 2026 comparable store sales. Global total comps are up a healthy 6.2%, right? And North America is providing a really strong baseline, up 7.1%. But then, look down at China. Total comp is practically flat at just 0.5%. But the truly dangerous divergence, the thing you really need to pay attention to, is in the breakdown. Traffic was actually up 2.1%, but the average ticket was down 1.6%. So yeah, they're getting slightly more people in the door, but those customers, they're spending significantly less per visit.
So what does this actually mean? It's crucial to grasp this concept, a same-store sales drag. Basically, this happens when falling ticket prices, usually because of heavy promotional discounting or customers just trading down to cheaper items, completely wipe out overall traffic gains in a massive market. And ultimately, that drags down the global comparable store revenue. It's a critical concept to get, because gaining traffic through aggressive discounting just hides the underlying margin pressure. It's basically low-quality growth, and it seriously weakens the global financial picture.
And why does this regional margin pressure matter on such a massive global macro scale? Well, because of this number, 7,991. That is the total number of Starbucks stores operating in China at the end of Q2 fiscal 2026.
When you've got nearly 8,000 stores experiencing sustained ticket price erosion, that isn't just some localized headache. It acts as a massive, heavy anchor dragging down the entire global company's comparable sales.
Let's hit Section 4, the Boyu Capital Joint Venture. This is their big capital-light shift.
Looking at this new strategic partnership, you can see the breakdown here. Boyu Capital is taking 60% ownership of Starbucks China retail operations. Starbucks retains the remaining 40%, while, and this is critical, continuing to own and license out the brand and the intellectual property. This is a massive shift toward a capital-light approach. It's clearly designed to reduce Starbucks' direct operating exposure over there and improve their reported capital efficiency. But here is the harsh reality we have to face. Yes, the joint venture absolutely improves capital efficiency on the balance sheet, but it does practically nothing to eliminate the actual structural problem on the ground. Think about it. If Chinese consumers fundamentally reprice the Starbucks brand in their minds, if they start viewing it as just too expensive in a value-driven market, Starbucks still faces a massive product-market fit issue. Boyu is basically providing capital-light life support, but it definitely doesn't solve the core consumer challenge.
Finally, Section 5, reframing the valuation model. Let's look at a much better framework.
First off, we have to call out the wrong ways to value Starbucks, because honestly, traditional Wall Street models are missing the mark right here. On one side, you have people treating Starbucks as just a basic restaurant chain. That's a massive mistake. It completely ignores the immense value of their brand, the incredible power of their loyalty program, and their premium pricing leverage. But then on the flip side, you have the opposite extreme, treating them as this invincible, bulletproof global luxury brand. And as we've literally just seen with the intense mass market price pressure in China, Starbucks does not have unlimited pricing power. So treating them like high fashion is just as flawed.
So to really get this right, we've got to adopt a better valuation framework. It's like a giant puzzle, and you need all these 5 layers. 1. You have to value it as a premium daily habit brand. 2. Recognize it as a business built on massive store-level operating leverage. 3. Factor in the loyalty and digital ordering platform. 4. See it as a global licensing and joint venture brand, exactly like we just saw with the Boyu partnership. And 5, don't forget it's a consumer packaged beverage brand too. You really have to synthesize all 5 of these elements to accurately price Starbucks' complex global ecosystem today. Just take a second to let that blueprint register.
So what does this all mean? Ultimately, the whole shebang comes down to this one question. Can Starbucks grow transactions in China without accepting permanent ticket and margin erosion? The turnaround in the US proves that they absolutely can heal domestic operations. But China, that's the ultimate test right now. If they can answer this with a yes and defend their premium relevance, China returns as a massive growth engine. If the answer is no, well, it remains a persistent mathematical drag. Thank you so much for joining me for this explainer. And hey, keep a really close eye on that traffic versus ticket math.